Leverage finance is a method whereby you use external funds in combination with your own cash to buy a return-producing asset. As an example, when you buy a property, you'd normally obtain external funding from a bank or the like to buy the property. And depending on how your credit scorecard is, you may be required to put an upfront deposit of your own cash. The return aspect of this is that it will either earn you rental income if you use the property for rent, or you'll get an income through the increase in the value of your property. However, this should not be confused with using debt to purchase a depreciating asset such as a car. Leverage finance is traditionally used by private equity firms or a consortium of investors when buying a company. This is normally termed as a leverage buyout due to the use of debt in buying a company. This debt is normally senior secured, which means it ranks above equity, and certain assets of the acquired company are pledged or ceded for the benefit of the lenders. Debt funders are normally investment banks. However, due to the evolution of banking regulations and internal risk management policies, banks have started to invite other participants such as fund managers. So more and more fund managers are taking part in leverage finance deals. With any debt investment, the key risk that you face is that your borrower would not be able to repay you back your capital and the interest. We term this as a credit risk. However, there are steps you can take to mitigate this risk. One thing that you can do is that you can perform a thorough due diligence, which is looking at the business character of the company, looking at the corporate governance structures, and then also performing a financial analysis to establish quality earnings, which should convert to sustainable cash flows. In addition to this, there's other protections that you will benefit from in the loan agreement. You will find clauses such as the financial covenants clause, which requires the company to report on a quarterly basis certain financial ratios such as the net debt to EBITDA or the interest cover ratio. You'll also find another clause, which is the permitted encumbrance clause, which limits the amount of security the company can provide for new debt. And lastly, you will get security which has been provided by the acquired company. A big difference is on the level of involvement and protection you have on the unlisted debt side. Listed bonds are normally issued on a senior unsecured basis, while in the unlisted space, specifically leverage deals, they would normally be issued on a senior secured basis. You would also not normally have financial covenants through the listed bonds, while in leverage finance deals, covenants are a normal occurrence. And lastly, in the listed space, you may be limited in interacting with management, while in the unlisted space or leverage finance deals, you'd have more frequent interactions with management. In summary, you are closer to the company and more legally protected in the unlisted space than you would in the listed space.